All right, so we've got this pretty detailed look at what's going on with the euro-USD exchange rate. I mean, you really dug deep into like all the factors shaping it from, economic indicators to the whole political scene and even what the experts are predicting.
Yeah, we really tried to cover all the bases here.
So our goal today is to kind of cut through all that complexity and really zero in on what the key takeaways are for for anyone who's trying to understand where this currency pair might be heading.
Yeah, that's the big question, right?
Exactly. So we've got a ton of info to work with here. We've got, GDP growth figures for both the Eurozone and the U.S., inflation rates, unemployment data, manufacturing indices, and we even dove into what the European Central Bank, the ECB, and the Federal Reserve, the Fed, are up to with their interest rates. Oh, and we can't forget about all the political and economic events that are swirling around right now. Plus, we've got a whole range of expert opinions, some insights from technical analysis, and a look at global market sentiment. I mean, it's a lot.
It really is. It's a comprehensive picture.
Yeah, but don't worry, we're going to guide you through the most important nuggets so you can walk away feeling like you really get it without being totally overwhelmed.
That's the goal.
All right, so this is where things start to get really interesting.
Yeah, let's dive in.
Let's kick things off by looking at the Eurozone economy. How's it doing? So we see that the GDP, which is basically the total value of everything they're producing, grew by a kind of modest 0.2% in the last quarter of 2024 and by 0.9% for the whole year.
Yeah, so a little bit better than 2023.
Right, a slight improvement, but still a far cry from that almost 6% growth they had back in 2021. And even compared to the previous quarter, things slowed down a bit.
Mm-hmm.
So it's
Yeah.
not exactly a picture of robust recovery. You know what I mean?
No, not really. I mean, it's more like this weak and uneven kind of growth, which kind of suggests that there are some underlying structural issues that they're grappling with.
Yeah, that makes sense. So what's really interesting here is that the different countries within the Eurozone are performing so differently. I mean, you've got Ireland, Denmark, and Portugal doing pretty well. They're showing strong growth.
Right.
But then you have Germany, which is the Eurozone's biggest economy, along with Malta, Austria, and Finland. And they actually saw their economies shrink a little bit.
Yeah, that's definitely something to watch.
Especially Germany. I mean, a 0.2% decrease for them, that's a pretty big deal given their size, right?
It is. Their economy carries a lot of weight within the Eurozone, so when they stumble, it's definitely noticeable.
So what's driving this mixed bag of growth? Well, when we look at the fourth quarter, it seems like household spending and business investment, those were actually positive contributors. But changes in inventories, those had a negative effect.
Right, so businesses are holding on to more goods, which could suggest that they're not as confident about future demand.
Interesting. So I guess this really highlights the challenge that the ECB faces, right?
Totally. They're trying to set monetary policy for a whole bunch of economies that are all moving in different directions.
Okay, so let's move on to inflation. That's the rate at which prices are going up. And in the Eurozone, the annual rate has actually been going down, which is good news. It hit 2.2% in March of 2025.
Getting close to that 2% target that the ECB wants to see.
Exactly. But there's this thing called core inflation, which takes out the prices of energy and food because those tend to jump around a lot.
Right, those are more volatile.
So core inflation was a little higher at 2.6% in February, and that kind of hints that there might still be some underlying price pressures lurking around.
Yeah, some stickiness in certain areas.
And then if you look at specific sector services like, going out to eat or getting a haircut, that had the highest inflation rate at 3.4% in March.
Interesting.
But again, we see these big differences across countries. Croatia, Estonia, and Slovakia have the highest rates, while France is way down at 0.9%.
Wow, that's quite a range.
Yeah, it is. So this kind of raises the question of how long is inflation going to stick around in certain places?
Yeah, especially in those services you mentioned.
Right, because even though that headline inflation number is looking good for the ECB, that core figure suggests that maybe they're not out of the woods just yet.
They've still got some work to do, potentially.
And then, of course, you pointed out the differences across countries.
Yeah, that makes things complicated.
It really does. It's tough to set one monetary policy that fits everyone when you've got such a diverse group of economies.
Absolutely.
Okay, so what about jobs? Well, the unemployment rate in the Eurozone is actually looking better. It fell to 6.1% in February of 2025, which is lower than their long-term average.
That's a positive sign.
Yeah, it is. But there's a catch youth unemployment that's still pretty high at 14.2%.
Yeah, that's a persistent problem, isn't it?
It is, and it makes you wonder if there are some deeper structural issues that are preventing young people from getting into the workforce.
Yeah, I mean, even with the overall jobs market, Improving youth unemployment remains a challenge.
And then there's this interesting contrast. Germany has a really low unemployment rate, but Spain's is way higher.
Yeah, that difference really underscores the varying economic realities within the Eurozone.
Right. It's like different worlds.
Okay.
Let's take a look at the manufacturing sector. And this one's a bit of a mixed bag. The PMI, which is a measure of factory activity, is still below 50.
So that means the sector's still contracting.
Right, but it's the slowest rate of decline in over 2 years, and factory output actually rose for the first time in 2 years, in March of 2025.
So there are some signs of life.
Yeah, but on the flip side, new orders are still falling, though, at a slower pace, and employment in the sector also decreased. Plus, the prices that manufacturers are paying for their inputs, the raw materials they need, those prices kept going up.
Yeah, those rising input costs are definitely a concern, especially for businesses.
So what do we make of all this? Well, it seems like the manufacturing sector in the Eurozone is at a turning point.
Yeah, a crossroads.
There are these glimmers of hope, but there are still some significant challenges that they're facing.
Right. That increase in factory output is positive. But the fact that new orders are still declining suggests that this upturn might not be super sustainable just yet.
Right, and then those rising input costs, they're adding to the inflationary pressures that we talked about earlier.
Exactly. It's a complex situation.
Okay, so let's hop across the Atlantic and see what's happening with the U.S. economy. So in 2024, the U.S. economy actually grew at a faster pace than the Eurozone, with a 2.4% increase in GDP in the fourth quarter and 2.8% for the year as a whole.
Right.
But even in the U.S., there was a slowdown from the third quarter.
A little bit of a cooling off.
Yeah, and when we look at what drove that growth in the fourth quarter, it was mainly consumer spending and government spending, but business investment actually decreased. And imports also went down, which might suggest that demand is easing up a bit.
Yeah, potentially.
So it's kind of a similar story to the Eurozone, right?
In some ways, yeah, there's growth, but the pace is moderating.
So what about inflation in the U.S.? Well, it's also been easing, which is good news. It hit 2.8% in February of 2025.
Okay, not bad.
And core inflation, which again strips out food and energy prices, that slowed down to 3.1%, its lowest level since April of 2021.
So that's encouraging for the Fed.
Yeah, I bet they're breathing a little easier. But it's
Yeah.
interesting, energy costs actually declined while food prices went up.
Yeah, so it's not like all price pressures have vanished completely.
Right, certain things are still getting more expensive.
And the Fed is going to be watching that very closely.
All right, so now let's talk jobs. In the U.S., the unemployment rate was 4.1% in February of 2025, which is pretty much unchanged from the previous month, but a bit higher than the year before.
So basically steady, but with a slight uptick.
Yeah, and there were also some other signs that maybe the labor market is cooling off a bit. The number of job openings fell slightly and layoffs increased.
Interesting. So maybe a little shift in the balance of power between employers and job seekers?
Maybe so, but overall the U.S. labor market is still considered to be pretty tight.
Yeah, relatively speaking.
Okay, so now let's move on to the manufacturing sector in the U.S. And this one's a bit of a head-scratcher because we've got some conflicting signals.
Oh, really?
Yeah, so the ISM PMI, which is a measure of manufacturing activity, well, that fell below 50 in March of 2025, which indicates a contraction.
Okay.
And demand and output weakened and new orders fell even further. Plus the rate at which manufacturers' input prices are rising, well, that accelerated due to the tariffs.
Right.
But here's the thing, the S&P Global U.S. Manufacturing PMI, another similar index, well, that one showed a slight expansion in March.
So one's saying contraction and the other's saying expansion.
Yeah, it's kind of puzzling, right?
It is. It makes you wonder if maybe one of them is lagging a bit or if there's some specific factors that one index is picking up that the other isn't.
Maybe so, but it definitely makes it harder to get a clear read on how the sector is actually doing.
Agreed. It's a bit of a wait-and-see situation.
Okay, so let's step back for a minute and try to make sense of everything we've learned so far about the U.S. and the Eurozone economies.
Okay, big picture time.
Right, so the U.S. economy grew more strongly overall in 2024 compared to the Eurozone, but both have seen a slowdown recently. Inflation is easing in both places, but core inflation is higher in the U.S.
Right.
And unemployment is lower in the U.S. too. And then we've got that weird mixed bag of signals from the manufacturing sector in both places.
Yeah, it's messy out there.
It really is. So it seems like the U.S. economy might have a little more momentum, but it's facing its own challenges, like that persistent core inflation.
And then the Eurozone's recovery is looking a bit more fragile and uneven, but at least their headline inflation is lower.
So basically two different pictures, two different sets of challenges.
Exactly, and this is where the central banks come in.
Right, because they have to respond to all of this.
Mm.
So let's dive into what the central banks are doing, starting with the ECB. So they cut their key interest rates by 25 basis points in March of 2025.
So that's a quarter of a percentage point.
Right, and it was their sixth rate cut since June of 2024, which brings their deposit facility rate down to 2.50%. Now, the deposit facility rate is basically the interest rate that banks get for parking their money at the ECB.
Right.
And the ECB said they made this move because they're seeing progress in bringing inflation down.
Makes sense.
And they also said that their policy is becoming less restrictive, which basically means they're trying to make it easier for people and businesses to borrow money and spend,
Right.
stimulate the economy.
But going forward, they said they're going to take a data-dependent approach, meaning they'll be watching the economic numbers very closely and making decisions meeting by meeting.
So no preset path.
Exactly. And they also mentioned that there's a lot of uncertainty out there, especially when it comes to global trade and geopolitics.
Yeah, those are big wild cards.
So they're being cautious. They're forecasting that headline inflation will average 2.3% in 2025 and then fall to around 2% in the following years.
Okay.
But they also lowered their growth projections for the Eurozone, which suggests that they're not super optimistic about the economic outlook.
A little bit pessimistic. And if you look at what the markets are saying, well, most people seem to think that the ECB is going to cut rates again.
Yeah, further easing is expected.
So they're not done yet.
Not by a long shot.
Okay, now let's switch gears and see what the Fed is doing. So in March of 2025, they decided to hold their target range for the federal funds rate steady at 4.25% to 4.50%.
So they paused their rate cuts.
Yeah, after 3 cuts in 2024, they decided to hit the pause button.
Interesting.
And they also stressed that they're going to be data dependent going forward.
Just like the ECB.
Yeah, basically everyone's watching the data very closely these days. But here's where things get interesting. The Fed is actually anticipating that core inflation is going to increase in 2025.
Really?
Yeah, and they've also lowered their GDP growth forecast for the year.
So they're expecting things to slow down.
But despite all of that, their own projections still suggest that they're planning to cut rates twice in 2025.
Okay, so they're expecting slower growth and higher inflation, but they're still planning to cut rates.
That's what their projections say. But there's a lot of disagreement in the market about whether that's actually going to happen.
Right, the market is skeptical.
Yeah, so basically there's a lot of uncertainty about the Fed's next move.
The Fed's always a bit of a mystery.
Okay, so we've got the ECB easing monetary policy and the Fed hitting the pause button with higher rates.
Two very different approaches.
And this divergence is probably going to stick around for a while, which means that the interest rate differential that currently favors the US dollar, that's probably going to persist too.
Yeah, so the US dollar is likely to remain more attractive to investors because it offers a higher return.
And that could put some downward pressure on the EUR-USD exchange rate.
Meaning the euro could weaken against the dollar.
But here's the thing, even though the Fed is on hold right now, everyone expects them to start cutting rates eventually.
Right, that's the general consensus.
And that expectation could limit how much the dollar strengthens.
Yeah, it acts as a kind of ceiling.
Plus, we have to remember those new U.S. trade policies. They're adding a whole other layer of complexity to this whole situation.
Right, because no one's really sure how they're going to play out.
Exactly. Okay, so let's talk about this interest rate differential in a little more detail. It's actually pretty significant right now. The ECB's deposit facility rate is at 2.50%, but the Fed's target range for the federal funds rate is between 4.25% and 4.50%.
So that's a difference of over 2 percentage points.
Yeah, and it's not just the central bank rates. If you look at government bonds like the U.S. 2-year Treasury yield that's been hovering around 3.62% to 3.97% in early April of 2025.
Yeah.
But the German 2-year Schatz yield, which is a similar type of bond, well, that's been way lower, around 1.86% to 2.19%.
So again, a big gap in returns.
Yeah, investors can get a much higher return by holding U.S. dollars.
Exactly, and that's why the interest rate differential is such a powerful driver of currency movements. It influences where capital flows.
Right, money goes where it can earn the most.
Right, and historically, this difference in interest rates has been pretty closely linked to how the USD exchange rate moves.
Yeah, there's a positive correlation. When the interest rate differential favors the dollar like it does now, the euro tends to weaken against the dollar.
Right, and this relationship has been influenced by both conventional and unconventional monetary policies.
Right, so things like quantitative easing, where central banks buy bonds to pump money into the economy.
That can have an impact on longer-term interest rates and influence investor sentiment as well.
So it's not just about the short-term rates, it's about the whole policy environment.
Right, the big picture.
Okay, so let's talk about the EUR-USD 2-year swap rate gap. This is basically the market's expectation for how those short-term interest rate differentials are going to play out over the next 2 years.
Okay, so what's the market thinking?
Well, the swap rate gap is currently negative for the euro, which means that the market expects the dollar to keep its advantage in terms of yield.
Even though it's narrowed a bit recently?
Right. There's been a little improvement for the euro, but it's still not enough to change the overall picture.
So as long as that interest rate gap persists,
Yeah.
the U.S. dollar is going to be the more attractive option for investors.
Okay, so let's shift gears a bit and talk about politics, because politics definitely matter when it comes to currencies.
Oh yeah, for sure.
So over in Europe, the European Parliament elections happened in June of 2024, and Ursula von der Leyen was reelected as the president of the European Commission.
Okay, so some continuity there.
Right, but then you've also had a bunch of national elections in different Eurozone countries, including Germany in February of 2025.
And elections always bring some uncertainty.
They do, because you never know how the new government is going to approach things.
Right.
So in Germany, the new government has approved a big fiscal stimulus package, which is basically where the government spends more money to try and boost the economy.
Okay, so they're trying to pump things up.
And there are also discussions about increasing defense spending across the whole EU. And that could have implications for both economic growth and inflation.
Right, because if they're spending more, that could stimulate the economy, but it could also push prices up.
Okay, so now let's look at the U.S. On that side of the pond, Donald Trump started his second term as president in January of 2025, and he's still very much focused on his America First agenda.
So more of the same.
Pretty much, yeah. And his agenda includes things like tax cuts, tariffs, deregulation, and changes to immigration policies.
Okay.
And the Republicans have narrow majorities in both houses of Congress, so it seems likely that he'll be able to push through at least some of his plans.
Right, he's got the political support.
But there's also been some uncertainty generated by a recent executive order related to elections.
Yeah, that's added a bit of a wrinkle.
And then we have the midterm elections coming up in 2026, so that's another political event to keep an eye on.
Always something happening.
Economically, the U.S. has already implemented those increased tariffs that we talked about earlier.
Right, those taxes on imported goods.
And those are expected to contribute to inflation and could potentially mess with global trade flows.
Yeah, tariffs tend to have a ripple effect.
And on top of that, there's talk of even more fiscal stimulus measures in the U.S.
Oh, there's more spending.
Yeah, which could boost the economy in the short term, but could also lead to higher debt levels and maybe even more inflation down the road.
So both the U.S. and the Eurozone have their own political and economic uncertainties to deal with.
Right. It's a messy world out there.
But it's interesting to see how those uncertainties are manifesting in different ways.
Yeah, in the U.S., it's all about the impact of those new trade policies. And in the Eurozone, it's more about adjusting to the recent elections and figuring out what to do about fiscal stimulus and defense spending.
And of course, we can't forget about the potential for escalating trade tensions between the two.
Right. Those tariffs could easily spark a trade war.
Which would be bad news for everyone.
Definitely. Okay, so now let's see what the experts are saying about all of this. Where do they think the EUR-USD is headed?
Yeah, what are the predictions?
Well, it's interesting because there's really no consensus. I mean, everyone seems to have a different opinion.
Oh, really?
Yeah. For example, RBC Capital Markets, they've actually revised their outlook to be more positive for the EUR-USD.
So they think the euro might strengthen.
But then you've got BBVA research, and they're saying that the dollar might be overvalued right now.
Okay, so they see potential for the euro to rise.
So then ING, they're predicting a dollar rebound.
So they think the dollar's going to stay strong.
Yeah. And then you've got Light Finance, and they're offering a bunch of different scenarios, some where the euro does well and some where the dollar stays on top.
So they're hedging their bets.
And Citi, they're projecting a rise in the euro-USD specifically because they think those U.S. tariffs are going to hurt U.S. stocks.
Interesting.
Yeah, so they see that as a negative for the dollar.
But
then you've got Ducascopy, and they're super bullish on the euro. They think it's going to do really well.
Okay, so a wide range of opinion.
Yeah, and it goes on Wallet Investor and Long Forecast. They have different predictions for the second half of 2025, and Coin Codex is the most optimistic about the euro. They think it's going to soar.
Wow.
UOB group. They think the EUR USD is going to trade within a certain range for a while, but they think it could go up in the long term.
So a more measured view.
JP Morgan, they think the euro might rise, but they still think the dollar is going to be strong overall.
It's a bit of both.
Wells Fargo, they're a little bearish on the EUR USD. They think it might go down.
Okay.
And then Bank of America, they think it might rise later in the year.
So a lot of conflicting views.
I know, it's hard to know who to believe.
It really is. But I think this just highlights how complex and uncertain the whole situation is.
Mm-hmm.
There are so many factors at play that it's really hard to predict what's going to happen.
Okay, so let's move on to technical analysis. What are the charts telling us?
Yeah, what are the technicals saying?
Well, the USD has a history of being pretty volatile. I mean, it can move around a lot.
That's for sure.
And recently, in early April of 2025, it's been trading around the 1.09 to 1.10 level,
Okay.
with a pretty noticeable jump upwards on April 2nd.
So a bit of a surge.
Yeah, so what does that tell us? Well, it could mean that the EUR/USD is consolidating right now, just kind of moving sideways.
Right. Finding its footing.
But that jump on April 2nd shows that it can still make big moves pretty quickly.
Yeah, it can be a bit jumpy.
Okay, so let's look at some specific technical indicators. TradingView, they're showing a buy signal based on a mix of moving averages and oscillator.
Okay, so some positive signs.
But InvestTech, they're pointing to a falling trend channel on the charts, though they also noted that there was a strong upward move after the price broke above a resistance level.
So some mixed signals there.
And it's now testing another resistance level, so we'll have to see if it can break through that.
Right, that's a key level to watch.
Central charts, they're saying there's a strong bullish trend in the short term.
So they're optimistic.
But FX Street, they pointed out that there was a sharp correction recently after the USAC hit multi-month highs. And they said that the RSI is retreating, which could mean that the upward momentum is fading.
Okay, so maybe some cause for caution?
So, yeah, it's a real mixed bag. Some indicators are saying buy, 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 and others are saying watch out.
I guess it depends on which indicators you trust the most.
True, but I think the main takeaway here is that there's a lot of uncertainty and the technical picture isn't giving us a clear direction.
Agreed. It's a bit muddy.
Okay, so another thing to keep in mind is that the USAD is really sensitive to global market sentiment. You know how people are feeling about the markets overall.
Like their risk appetite.
Exactly. And when there's a lot of fear and uncertainty in the markets, what we call a risk-off environment, well, the dollar tends to do really well.
Yeah, it's seen as a safe haven.
So people flock to the dollar when they're worried about things. And right now, there are some worries about the U.S. economy and the impact of those new tariffs, and that could definitely make the USD more volatile.
Yeah, more prone to big swings.
And then there are also correlations with other currencies that can be helpful to watch.
Oh, yeah. Those can provide some clues.
So the USD often moves in the same direction as the GBP USD, which is the British pound against the dollar.
Okay.
And it tends to move in the opposite direction to the USD CHF, which is the Swiss franc against the dollar.
Interesting.
And it typically has an inverse relationship with the US dollar index, which measures the dollar's strength against a basket of other currencies.
Right. So if the dollar is strong overall, the euro tends to be weak.
Exactly. So those are just a few things to keep in mind as you're trying to figure out where the USD is going.
Additional pieces of the puzzle.
Okay, so looking ahead, what are some of the key events that could move the USD?
Yeah, what's on the calendar?
Well, the ECB has their next monetary policy meeting on April 17th, 2025, and there's a good chance they'll cut rates again.
Okay, that's a big one.
And then we'll get the U.S. non-farm payrolls report, which tells us how many jobs were added to the U.S. economy.
That's always a market mover.
And, of course, any speeches or statements from ECB or Fed officials, those are going to be scrutinized for any clues about future policy.
Yeah, every word is analyzed.
And we can't forget about the ongoing impact of those U.S. tariffs on the EU and any retaliation that the EU might take.
Right, that's a big wild card.
And then there are all the fiscal policy developments in both regions and any major geopolitical events that could pop up.
The world is a volatile place.
It is. And looking further out, we've got the U.S. midterm elections in 2026 and the evolving political landscape in the EU.
Right, so the political scene is always shifting too.
It's a lot to keep track of.
It is, but it's all interconnected.
So let's try to imagine a few different scenarios. One possibility is that the U.S. economy keeps chugging along and the Fed stays hawkish, meaning they're more focused on keeping inflation under control than on stimulating growth.
Okay, so a strong dollar scenario.
Right, because if the U.S. economy is doing well and the Fed is keeping rates high, Well, that's going to make the dollar attractive to investors. And if the US and the EU get into a trade war, well, that could make the dollar even stronger because people might see it as a safe haven in times of turmoil.
Yeah, the dollar tends to benefit from uncertainty.
But another possibility is that the Eurozone economy recovers more strongly than expected, and the ECB is more cautious about easing monetary policy.
So a euro comeback scenario.
Exactly. And if the US and the EU can avoid a trade war, well, that would be good for the euro too.
Right. Less uncertainty, less risk aversion.
And then there's the possibility that we just end up with range-bound trading in the Euro USD for a while, where it just bounces around within a certain range.
Just a stalemate.
Yeah, basically because there are so many conflicting forces at play, it's possible that neither currency will be able to gain a decisive advantage.
Makes sense.
So I guess the big question is which scenario is most likely?
Well, if I had a crystal ball, I'd tell you.
Yeah, right.
But unfortunately, it's really hard to say with certainty.
Yeah.
The truth is that all of these scenarios are plausible given what we know right now.
Okay, so let's bring it all home. What does all of this mean for you, the listener?
What's the takeaway?
Well, based on everything we've discussed, it seems like the dollar is probably going to stay strong against the euro, at least in the near to medium term.
Okay.
And that's mainly because of the interest rate differential, the fact that the Fed is keeping rates higher while the ECB is cutting them.
Right. That makes the dollar more attractive.
And even though those U.S. tariffs are creating some uncertainty and have even pushed the dollar down a bit initially, they could actually end up supporting the dollar in the long run.
How so?
Well, because if those tariffs contribute to inflation in the U.S., that could make the Fed hesitant to cut rates aggressively.
Right. They might want to keep rates higher to fight inflation.
Exactly. So those tariffs could actually end up delaying Fed easing, which would be good for the dollar.
Interesting.
But of course, things could change if the Eurozone economy rebounds strongly, or if the US and the EU can work out their trade differences. Well, that could definitely shift the outlook.
Yeah, those are big ifs, though.
They are. And as we've seen, the experts are all over the map with their predictions, and the technical analysis is pretty mixed, too.
That's a fun to call.
It really is, but I think the key takeaway here is that the fundamentals seem to favor the dollar right now.
At least for the time being.
So that's our deep dive into the USD exchange rate. It's a complex situation, but hopefully you feel a little bit smarter about it now.
I hope so.
But this is just a snapshot in time, right? The global economy and the political landscape are constantly changing, so it's important to stay informed.
Absolutely.
So as you continue to watch the USDC, what are the things that stand out to you? What questions are you left with?
Good questions.
And remember, there's always more to explore. We could dive deeper into the specifics of trade policy or central bank communication, but for now, we'll leave you with this thought.
Okay.
What if those new U.S. tariffs end up triggering a full-blown trade war with the EU?
That's a scary thought.
It is.
Yeah.
How do you think that would affect the long-term economic prospects of both regions?
Yeah, that's a big one.
And how would it impact the EUR-USD exchange rate? Something to ponder as you navigate the wild world of currencies.
Thanks for listening, everyone.
And thanks for joining me on this deep dive.
It's been a pleasure.
Until next time, happy trading.
Happy trading, everyone.